Good afternoon, class. This is Professor York here. I'm going to do a recap on Monday's lecture, which dealt with a variety of key things like key elements to impress investors, value proposition canvas, product market fit, and market sizing. Okay, so those are some of the key things that we're going to be touching on today. So why is this so important in terms of investors? And this is just quotes from some folks who I work with down in San Diego, but Eric Gasser, who is with Tech Coast Angels down in San Diego, says one of the important things that we need to keep in mind is that why investors do not invest is because, especially in the early rounds, is that there's a lack of what we call product market fit, or PMF. Randy Gerson and Christy Owen from Gerson Associates and do Marketing Mondays over at Evo Nexus say, many times they can't identify the right customer, which, as we know, customer segments are very, very critical. We hear many businesses say, oh, we're for everyone, and they can't identify the value or the value proposition or benefit. So how do we identify the value proposition and opportunity? And the next few slides we're going to go through will give us a better feel for that. And there's two tools that you will be using this quarter. First is the value proposition canvas that you see in the lower right-hand corner. That is there, okay? And that is this piece, and then there's the business model canvas, which we'll be talking about in our next lecture. And you can map basically the VPC, to the piece of the VPC to the BMC, and you can see the customer piece or segment piece and the value piece, which ties to your product or service. So let's talk about customer profiles. Okay, you'll hear pains, gains, job to be done. So pains are very, very critical, as I talked about. They are what are the critical problems, disasters, losses that this customer or user needs to fix to never occur again. And these can be undesirable. It could be, and again, as we talked from our painful interview, functional, emotional, ancillary. They could be even social. Okay, obstacles, something that is a bottleneck. Okay, from getting a job done more efficiently, or getting a customer to start a job, e.g., I don't have time to put my first draft of this report that I have to do. And then there's risks, and this is where we get into insurance options, or for instance, like Ring, I think we talked about as a solution to enhance security of your home so that individuals won't break into your home. And so you then tie these pains to what we call relievers, and their actions, their verbs, okay? How the product alleviates that customer pain, and what are you fixing or helping customers avoid that they hate? So think about these, and if you look across these that relate to those previous pains, what you start seeing are benefits, and these have become the basis of what we call value proposition. So if you go back to the Bain triangle, which is really follows Maslow hierarchies of needs, what you start realizing is that we need to be thinking about in that value proposition piece in terms of these type of examples that should fit in relative to the customer pains. And those customer pains are what you tease out in your interviews. Then alternatively to a pain is a gain, and sometimes individuals get that confused, but let's see if we can tease this out a little better. A gain is outcome or benefits that customers want and they're trying to achieve. So best example is going to school at Cal Poly. Your education ultimately will give you a gain that will improve your career prospects, etc. And examples can be required, like basic things like basic food and clothing. Expected gains, okay? Now, this is things that we expect, okay, that should come out of a purchase. The product should work. The food should be cooked, okay? Desired gains is, getting now in terms of what we would love to have, okay, ideally, okay? And this is where I sometimes will pose, if you had a magic wand, what would the product look like in terms of getting them to sort of imagine what what would be ideal. And then unexpected gains would be exceeding customers' desires, and we all have had that in terms of going to a restaurant, or maybe it's a piece of clothing, maybe it's a car, maybe it could be some other type of product that we've got, and that just, we love it so much, it does so great that, or like your iPhone, that it exceeds your expectations, and you tell all your friends about it, and you create a viral loop. Okay, so here I think we talked in lecture was, like a dishwasher. Automatic dishwasher is a pain reliever because we hate doing dishes, but a dishwasher that unloads itself and puts the dishes away would actually be a gain creator, because that is not necessarily the core job that a dishwasher does. And so some of our gain creators is having a product and service that creates those gains, so that helps you achieve something that you couldn't do. So again, action verbs, think about that. Okay, so here again, outcomes that we're looking at: savings, meeting, exceeding expectations, outperforming competitors, which is critical, especially in a marketplace where it's more of a red ocean, where you have competition. So you need to be thinking about how you're going to outperform the competition. And then fulfilling customer desire, aspiration, e.g., say, wedding planner, in terms of really creating the optimal or the most wonderful wedding experience for a bride. Okay, producing a positive outcome, and that could be in terms of if you are going to have work done on your teeth, that a crown fill, you want to make sure that crown is perfect. Okay, so those are some great creators, but keep in mind in terms of that what we're looking at are action verbs. Think about the Bain triangle, and that will help you a whole lot. So these are sort of, I like to say, gain creators are tack-ons, where pain relievers are basically, we're trying to take away major headaches. And then there is the concept of what we call customer jobs. We talked about the milkshake example, and this is something that Clayton Christensen from Harvard talks about. And so in many ways you have three different types of jobs. But it's, what is the job that your customer is trying to get done? Problems to solve, needs to satisfy. And so those jobs can be functional, social, or emotional. And I think I gave you an example of the hospice that we had used when we had a very, very ill animal. So it was not just in terms of the functional job of taking care of the needs of the animal, but also the emotional job that was for the animal owner. So those are some things to be thinking about in terms of as you create your value proposition. And to that, you want to map that in terms of the products and services. And those can be physical, okay, in terms of actual pure goods, your iPhone, for example, intangible, which can be copyrights or customer support. And copyrights are really critical when you create, e.g., music or a work of art or a literary piece. Digital can be in terms of downloads of music or software, as we're seeing more and more software platforms actually like Adobe, even Microsoft Office are basically in the web. And now you basically experience it on a subscription basis. And then financial, in terms of investments that are being made, or insurance, or financing, say a mortgage on a house, or better yet here, you might have a loan, a student loan, to finance your college education. So those let you fulfill a certain job. So what the customers see when they look at your product that is there. And as I talked about this beforehand, this will be a very useful tool, is think back to functional, emotional, life-changing, and social impact as we move up those needs and the value of those needs. But these are things that you should be thinking about in terms of the job to be done, either relieving a pain or solving a problem or creating gain that's there. So I just was talking with actually a mentee this morning. We were talking about two customers. We were dealing with a classic queuing problem, like waiting in line for a restaurant, and perhaps putting together some type of app to address that problem. And, customer one being the customers waiting online, reducing anxiety. But for the customer that may be the restaurant customer, it may be in terms of simplifying things or making money, making things more efficient, reducing effort. So it's important to be able to map these things out when you do your value proposition canvas to tie back to your product, so that your product fulfills those functional or the job to do, and then ultimately into your business model canvas. So I want to segue to MVP, and we're not talking about most valuable player, we're talking about minimum viable product. So what is that, and what is an example? So MVP, minimum viable product. Okay, basically it's in product development, the minimum viable product is the product with the highest return on investment versus risk. So what we're trying to do is get away from just a pure crappy product, but the most minimal to do the job, and that it's viable. Okay, and you don't want to get to where companies or products are overbuilt, which we see this sometimes in the engineering disciplines or even medical disciplines, where products are just overbuilt. And they're too perfect, and artists do the same thing. You want to get to where you have most minimal and most functional, so you can get out in the marketplace and see if you can get traction. This is very important. Okay, and so what it is and what is not. So what it's not is, like, if we're going to build a car, we're going to deal with the need of transportation from point A to point B. Well, you're not going to build a car, basically sequential, the different pieces, but if going from point A to point B, what you're actually going to be doing is look at what's most minimal. And I've seen this actually in San Francisco. I've seen it on campus where students get a skateboard. That's the most minimal, get you from point A to point B. And naturally, there is the having the full car, a Lamborghini, etc. That is, and this is what we're talking about in terms of minimum viable product that really will allow us to do that job of transportation, where the tire just does not do that. And a few other examples is, like, you may see this in terms of a landing page with a get started, or what we call a call to action button. Dropbox is a very good example of a company that started with that type of interface, and based on the interest that was created off that landing page, and maybe a very, very dumbed down version of it. And this is something that Sean Ellis, who has written Hacking for Growth, did, was be able to gauge the traction then that was getting in there. Sometimes you'll see on Kickstarter some basic videos getting interest, and if enough interest is there and hits the target of that you've set for Kickstarter, that many times is an MVP, and the product hasn't even been built, but they're getting orders. And this is very critical, because you want to know, do I have enough interest? Have I fulfilled the needs that at the end of the day we have something? So what is that something? That something is what we call product market fit. And why is it so important? Well, according to Mark Andreessen, who many of you may not be familiar with, but he founded Netscape, which was ultimately bought by Yahoo, and now is one of the most influential venture capitalists up in Palo Alto. So he's been around the startup world for at least a good 20 to 25 years. But basically, it's about product market fit. And what Andreessen says is the only thing that matters is getting this, and that it means good market, okay, with a product that can satisfy that market. And sometimes you can always feel it when you see it, and when it isn't happening, okay, which is uptake. I use the bungee jump and with the cord catching, and I think we used the example in class where I think one of the students talked about doing parachute, and you're free falling, and all of a sudden the chute engages, and you feel the product fit in many ways. Seeing that engagement in the community of customers for your product is very much like that. Okay, and I think I used the example of the brown butter cookie company in terms of their story to illustrate that. But to this is going to be the market, which I'll talk about in a few minutes. But how does the entrepreneur determine product market fit? So there is actually another canvas called the product market fit canvas, which is actually in the folder that has your value proposition canvas as well as your business model canvas. But what's good about mapping this out is that you start thinking about your customer segment in terms of the job to be done, the characteristics, the problems and needs, the channel, is it going to be digital or physical, and what is the user experience? And that's on the customer side. So as we talked about in the value proposition canvas, we had the customer side, and then you have the product or service side. And what you need to be thinking about is, here we have this product, but what alternatives are there? And that also means the status quo. Okay, also means not just rivals, but also substitutes. Key features. So, when you map in terms of your customer needs, what are the key features? And this will be something that you'll be doing when you do your MVP presentation and testing. And then you'll be asking questions about the value of the channel. Is it most effective and efficient to be able to go through, say, the Amazon or the App Store, or should you be a standalone website, or should you be selling on eBay, or should you be going through a physical wholesaler? And last but not least, which is very critical, is you need to measure things. So you need to measure, and we'll talk about funnel metrics later on in terms of the marketing funnel, in terms of get, keep, grow. But the get piece is very critical in terms of how efficiently are we able to get and acquire those customers, okay? And so we call that funnel efficiency in terms of with the get, but also in terms of the cost to acquire and keep a customer is going to be another key metric with a startup. So how do we validate this? So there is a process called Lean. Eric Rice, who is a disciple of Steve Blank, who you've gotten familiar with from the videos. Eric wrote this book called The Lean Startup and has generated literally a new business around Lean Startup. Eric's first company, which Steve had invested in, and Eric had to go through Steve's class, which is similar to this class, which Steve taught up at Berkeley, that was the deal to start this company, which you guys might be familiar with their product, which are the emojis. And Eric did a pretty good job there. So anyway, the concept is very similar to agile software development, which is you have an idea that's you're gonna build into a product, and that product you're gonna test and in the marketplace. So you're gonna run an experiment, you're gonna get data. It's gonna be the most minimum viable product that is there. Get data, use that data to make a decision. Have I met the market, or have I not met the market? Use that data to learn, and then to modify your idea and ultimately your product as well. That may result in a full-scale pivot in terms of your overall business, or there might be just in terms of what we call just modifications going along. But this experimentation is done with software, and what the lean process is rather than spend a ton of time and a ton of money in building the most perfect product, is to get a sense as you have early versions of the product and video whether you are hitting the market need and the customer's needs properly, or are you totally missing. And it's okay to fail. That's up in Silicon Valley, as long as you learn and can be able to apply those learnings to future business ideas. So the other part of product market fit is the market and market sizing. Okay, and why is market sizing? And I'm also going to talk about a concept I don't have a slide of, but CAGR, C-A-G-R, which is compounded annual growth rates, because it'll tell me how fast a market is growing as well. So one of the things that investors think about, and this is Jay Coonan, who is with, again, Tech Coast Angel San Diego, is, are we dealing with a lifestyle business, which may be, 1 to 10 million, or are we in a business that can scale, that we can make this $50 million, $100 million? Why? Investors want to know two things. They want to know, can they get 10x out to 24x return, and also the day that they're going to exit. So they want to know if they're going to put the investment, do you have a vision that you're going to grow and scale this business, that we can get good return? Are we going to go IPO, or are we going to get acquired, or we can get such returns on this business in terms of cash flow that, the money that I put in as an angel, which can be, a seed can be anywhere up to 750,000, or down to, seed to A and B rounds, which will be, $1 million, $2 million, to D rounds, which can be 5 to 10 million. There is a cost to that. The investor is going to want to have that return for the risk that's going on there. So these are things that you need as an entrepreneur to be able to think about in terms of how large that market is. So we talked about TAM, SAM, SOM. This will be something that even on your final presentation you'll need to be responsible for. So TAM being the universe, okay? So it may be a universe of transportation vehicles. The serviceable addressable market gets a little more focused in terms of clear future user growth in a market that presents with rapid and predictable growth. So this could be, I think we talked about the example of trucks. And then serviceable attainable market being really a specific type of truck, such as pickup trucks, which is the target market. So TAM and SOM. And there are two ways you can size these markets. One could be from top down, using various library resources as well as interviews with customers and press releases and industry and market research reports, or bottoms up, which are more realistic, which may be based on epidemiologic and customer information, surrogate markets, and using analysis and conversions to pull together market size. And the bottom up is going to be more realistic than the top down. But at the end of the day is the first step that you want to do is you want to know, are you in a lifestyle business, or are you on a business that truly is something that could grow out to being something very serious in terms of market that that investor wants to participate in. The other question an investor will ask, in addition to size, is going to be growth rate. And that's where the compound annual growth rate is. And that's basically looking at from year 0 to year 5. And then there's an equation that looks at that growth rate between the size of the market at year 0 versus the year 5 or year 3. And then you can project out, if you are double-digit growth rate or single-digit. Large markets, and this is very tricky, you need to understand, very large markets are going to grow at slower growth rates, whereas very small markets are going to grow at very high rates. So you need to keep that in consideration when looking at that way of characterizing the market. And sometimes with a small market, you then flip out to be able to share that while it's a small market, the growth rate in this market, such as a virtual reality, maybe the dollars are small today, but the growth rate might be in, we're talking 50-60% growth rate annually. So that's, investors like to get into that, especially when we're dealing with blue ocean type of markets. And this is just an example of top down in terms of looking at virtual reality and personalized medicine. So we've gotten these from some business reports, as you can see from references. And here in terms of how we characterize actually 3 different indications for eye diseases, as we were looking at which is the largest market opportunity, which happened to be diabetic retinopathy, but also in terms of a market that might be allow us for a faster track, which is neovascular glaucoma, because it's a rare disease which can get a faster FDA pathway because it's an orphan pathway. So sometimes that data is used not only just to characterize the size of the market, but also in terms of some strategies that you might take to get to market. And last but not least is this is not like our EIR's spreadsheets, but this is just a good way of being able to put together, and we did this for a project that we did for Berkeley, and it was on a Genentech product in metastatic breast cancer, is taking actual data from patient numbers as well as actual use data and pricing data for various chemotherapy products that were used in metastatic breast cancer, and then being able to put together a model that had, as we talked about in our market modeling lecture, about price, use, market share, and patients. And putting those pieces together, you can then calculate both in terms of first-time metastatic breast cancer patients as well as breast cancer patients who have recurred and now become metastatic, and be able to characterize a full market size. And as you can see, that market being at 1.53 billion, which is netting out from these two sub-models. But as you can see in each of the models, I have price, I have percentage of the patients that we are estimating to be, and then we can also send annual cost per year in terms of different treatments. So we can put these pieces together to be able to calculate a market size. And tends to be more. So I think we're at the end of the lecture. Hopefully this is a lot faster than what we did as our interactive lecture, but a good review. So remember, customer needs and job to do, very critical in terms of the VPC. Market size and growth is key. But realize in terms of when you're dealing with growth, in terms of the CAGR and the size of your market, because it could be misleading. Remember, you need to have product market fit. That's what Mark Andreessen says. That's what guys doing at Tech Coast Angels. And remember to know who your customer is and their needs. Okay? And very, very critical to be specific to understanding now those two elements and to really hone it in. If you do that, then you're going to be taking first and very, very positive steps to really identifying a problem to solve, a customer, and ultimately to develop products that customers want and want to use. All right. Anyway, have a great afternoon. All right. And thanks for watching.